Welcome back to Her Grip, the space where we talk money, mindset, and making finance your superpower. I'm Geeta, your host, and today I want to share a little secret. You don't always need a fund manager to manage your investments. In fact, you can be your own fund manager. Yes, really. And no, it doesn't require a suit or a Bloomberg terminal or an office on the Wall Street. What it does require is a framework, and I'll walk you through it. But first, let me take you back a bit. I started investing around 2015. Honestly, it was very much learner mode, like stock investing for dummies mode. I had no fancy tools, no mentors, just a lot of curiosity and an Excel spreadsheet and a certain willingness to make some mistakes. And over the years, I realized something that I genuinely enjoyed the process. I loved reading annual reports and learning about how these companies make money and seeing those patterns emerge. And then came COVID. So, between the chaos of homeschooling and everything else, I suddenly had a lot of time and mind space, like time to really study, analyze, and think deeply about investments. And that's when it hit me. Instead of putting my money in mutual funds and trusting a certain fund manager to make decisions for me on my behalf, why not do it myself? How hard could it be? Of course, I quickly realized it was not as simple as picking stocks at random. I needed a framework, I needed schedules, I needed to check in regularly. But the more I built on this structure, the more doable it felt. Eventually, that framework became my blueprint for being my own fund manager. And just so you know, quick disclaimer, I'm also in the process of studying to become a certified fund manager myself, but in true Gripdo spirit, where we teach fishing and not handing fish. I firmly believe that each of us has the ability to manage our own hard earned money. So let's go back to 2021. I put that framework into action. I created four baskets of stocks, each of them around a theme. The first theme was banks because I believe that finance is the backbone of every economy. And second basket was tech because back then I believed that future was being coded line by line. Third one was monopoly stocks, where I chose companies that dominate their industries. And the fourth one was EVs, because the world and India in particular was clearly moving electric. Now, here's a fun fact. You might think I had loads of money back then. Not at all. That was not the case. What I did have was a head full of ideas. Plus, I did a lot of intraday and swing trading. So these baskets were entirely built through SIPs, monthly installments that were funded from my trading profits. Fast forward to today, two baskets are up around 40%, and the other two are nearly at 80%. And that's when it really hit me. I wasn't just investing, I was acting like my own fund manager. And just to be clear, these baskets are not recommendations. They made sense to me in 2021 because of the runway those sectors had at that point. In 2025, I would build completely different baskets. The point isn't the specific stocks, it's the framework, the approach, and the mindset. Now, why be your own fund manager? Why put in the effort? Well, yes, the fees are certainly lower, but that's just the tip of the iceberg. Who else would know your risk appetite better than you? Who else knows which sectors spark your curiosity or which stocks you're secretly cheering for? Being your own fund manager gives you that freedom to explore, experiment, build a mini portfolio that reflects your worldview. It's also an education in itself. You don't just see your money grow, you understand it. You learn why stocks fluctuate, what makes a business strong, how the sectors evolve. That knowledge stays with you far longer than any market rally. And the flexibility, this is what I truly loved about this whole being your own fund manager, you get to pick themes that excite you. You know, digital India, renewable energy, women's empowerment, even the good old consumer goods. You decide quarterly adjustments based on what feels right. There's no hidden fees, no layers of complexity. You know, you could think of it like cooking your own meal versus ordering takeout. Takeout is easy, but cooking, you control the ingredients, you experiment with flavors and celebrate when it turns out well. Investing is the same. When your mini portfolio thrives, the dopamine hit is real, and that confidence feeds your long term investing mindset. So now we've reached the heart of today's episode, the framework for building your own basket of stocks. Now, this is where the magic happens, where you turn your ideas into actionable investments. Step one would be to pick a theme. Now, this is the most critical step. Choose something that you believe will shape the future. Could be AI in India, could be green energy, healthcare for all, but don't just stop at what sounds exciting. Make sure your theme is forward looking, it has a real runway for growth, and is gaining awareness and traction in usability. At the end of the day, remember it also has to be a profitability theme. We are here to build wealth, not just support a cause. Step two would be study the sector. Once you've picked a theme, dive into the sector itself. Look at the tailwinds. It could be government policies, or it could be global demand, or any demographic trend. And don't ignore the headwinds, which come in the form of competition, extra regulations, or slowdowns. Also, ask questions like, you know, is there money flowing into this sector? Are we seeing new investments, expansions, market share battles? Often a few brands will have already cornered the market, but that doesn't mean it's closed off. There's usually plenty of room for others to grow. Study the value chain in detail, because sometimes the best opportunities are not the big household names. It would be the smaller players that quietly keep the whole system running. Step three would be filter the stocks. Now, this is the exciting part, picking the winners. Ask who has a moat, who can survive storms, who is adaptable. Now, here's the thing, I have a very long checklist that I teach in my deep dive classes, and it can run for 3 hours plus. But in short, you would want consistent profits, low debt, strong brands, adaptability. And here is where your own risk appetite matters the most. Large cap companies are like banyan trees, you know, steady, sheltering, but slower to grow. Mid and small caps, they can give you like higher returns, but also plenty of sleepless nights. So the right balance depends entirely on how much risk you can stomach and how confident you feel in your picks. So, step four is create your basket. Once you've filtered, build your basket. Aim for 5 to 10 stocks, maybe 12 max. That way, you're diversified but not diluted. And here is where the value chain comes in again. If you're, say, for example, your theme is healthcare, don't just stop at a hospital and a pharma stock. Add in diagnostics, add in medical devices, insurance, maybe even third party service providers. Together, they create a portfolio that represents the full picture of your theme. Then SIP into it regularly, because in the long run, consistency always beats timing. Step five, review and rebalance. Don't just create and forget it. Every quarter, check in. Look at company financials, revisit their moats, see if the fundamentals are still solid. Then keep the classics, ditch the duds, just like cleaning out your wardrobe. And finally, step six, have an exit strategy. Now, this is the most underrated part. Just because a basket is doing well doesn't mean you hold it forever. Each story has an arc. A solid exit strategy, knowing when to take profits, when to reduce exposure, helps you multiply your returns and protects you from being caught off guard. Exiting smartly is just as important as entering wisely. Now, reality check, of course, there are risks. Don't get carried away by hype. Don't put all your eggs in one basket, and don't stop your SIPs just because of a bad week or a month in the market. Being your own fund manager also means managing multiple mini portfolio crises like the pros do. Markets will be volatile, so it's important to keep an eye on the bigger picture, the macroeconomic signals, and how they might affect your themes. Some sectors may look trendy and very convincing, but before jumping in, double check and triple check the fundamentals. And remember, diversification is non negotiable. Mutual funds give you this on autopilot. But when you are building your own portfolio, you'll need to consciously spread your investments across asset classes, across market caps, and across sectors. SIPs remain the best way to keep your market basket profitable through the market cycles. Now, if you've done the work and researched your companies, your job is not to obsess daily, but to monitor smartly, stay consistent, and trust the power of long term investing. So, here's my challenge for you: stop being a passive passenger. Pick one theme you truly believe in. Could be digital India, clean energy, women's empowerment, whatever fires you up. Put it down on paper, sketch a basket of stocks, and track it for 3 months. That's your first step into the driver's seat of your own portfolio. And if you're ready to level up, join me in my stock analysis class where we go from big picture to sector to stock to moat to basket to an exit strategy. You'll walk away with the confidence to build your own portfolio, not just borrow someone else's. Thank you for tuning into Herbert. If today's episode lit a spark, share it with that one friend who's always grumbling about fund manager fees. And remember, no one will understand your dreams, your risk appetite, or your vision better than you. The best fund manager for your money is you. Take care.